If you're self-employed and you've been told you can't use your VA loan benefit, I want you to watch this entire video before you give up. Because most of the veterans I talk to who have been told no on a self-employment scenario were either working with the wrong lender or nobody took the time to actually explain how this works. Self-employed veterans qualify for VA loans every single week, but the income calculation is different. And if you don't understand how it works, going in, you can accidentally disqualify yourself without even knowing it. By the end of this video, you're going to know exactly how VA underwriters calculate self-employment income, what documentation you need, and one thing a lot of self-employed veterans do on their taxes that quietly kills their approval. My name is Dallas Frye. I'm a former Marine Corps infantry officer. Now I'm a loan officer. I help veterans all over the country navigate the VA loan process, including veterans who are self-employed, business owners, 1099 earners, and guys and gals with complicated income situations that other lenders don't want to touch. Let's get into it. The VA prefers applicants to be self-employed for at least 2 years. That's the official language directly out of Chapter 4 of VA Pamphlet 26-7. Less than 2 years can still work, but it requires previous related employment or specialized training. Less than 1 year almost never qualifies. Here's the key thing to understand. The VA doesn't give underwriters a rigid formula on self-employment income. It gives them guidelines and tells them to use their judgment. That means your loan officer's knowledge of the VA Pamphlet 26-7 and the actual guidelines can be the difference between you getting approved and you not getting approved. Your loan officer matters. So here's the documentation that the VA requires. It states a current financial statement in an industry recognized accounting format. What does that mean? That can be a year-to-date profit and loss statement. We're going to need that. We're going to need a current balance sheet and individual income tax returns that are signed and dated for the previous 2 years, plus all applicable schedules. If the business is a corporation or partnership, you also need signed federal business income tax returns for the previous 2 years and a list of all stakeholders or partners showing their ownership interest. One more thing. The financial statements have to be completed after the halfway point of the tax year to verify current income stability. And if the lender or underwriter needs it, they can require a CPA prepared financial statement depending on the nature of the business. Most veterans don't know that's even an option. For self-employed borrowers, underwriters are not looking at your gross revenue. They're going into your tax returns and calculating your net income after deductions. Let me show you a real example. This is an actual calculation from an S corporation borrower. So we got K-1 lines 1, 2, and 3. These represent the borrower's share of the business income. In 2025, that number was just shy of $90,000. In 2024, it was about $48,000. Then we add back the cash flow adjustment. This is depreciation, money the IRS lets the business write off as an expense, but that the VA adds back to your income because it's not actually cash leaving your pocket. In 2025, that was $5,564, and in 2024, that was about $19,000. Add those together and you'll get the K-1 subtotal. 2025 looks about $94,801, and 2024 just shy of $67,000. This borrower also received W-2 wages from the S-Corp, $5,875 in 2025 and $3,750 in 2024. Add those together. Total annual income of $100,676 in 2025 and $70,208 in 2024. Divided by 12. Monthly income of $8,389 in 2025 and $5,850 in 2024. Because income increased year over year, the underwriter averages the 2 years. The qualifying monthly income on this file is $7,120.17. That is what the underwriter uses, not the gross revenue, not the bank deposits, the net income after deductions averaged across 2 years. So I want to talk about something that a lot of loan officers don't take the time to explain, and it matters. When we look at a W-2 borrower, hourly salary employee, we generally want the front end of the housing expense to be no more than about 25% of the gross income. With a self-employed borrower, there's more flexibility, and here's why. If your business brought in $240,000 in gross revenue, your gross monthly income is about $20,000. 25% of that is roughly $5,000 a month for housing. Both properties we're about to look at fall below that threshold. One has a total monthly payment around $3,905. The other is around $4,182. But it's not going to look that clean on paper because the qualifying income the underwriter is using is $7,120, not $20,000. So the debt to income ratio on paper is going to look a lot higher than it actually feels in real life for this borrower. A good loan officer understands that context. A self-employed borrower with $240,000 in revenue and a $4,000 mortgage payment is in a very different position than that same hourly or salaried W-2 employee qualifying on $7,120 a month. The numbers look similar on paper. The reality is completely different. This is where a lot of people run into trouble. If your self-employment income went up year over year, underwriters average the 2 years. That's what happened in our example. Income went up 43% from 2024 to 2025. So they averaged it. If your income went down, underwriters are likely going to use the lower year. And if the decline is significant, they're going to want to know why. The VA pamphlet is direct about this. If the business shows a steady or significant decline in earnings, the reasons for that decline must be analyzed to determine whether the trend is likely to continue or reverse. That is not automatic denial territory. It may mean a manual underwrite, and we'll talk a little bit more about that in a minute. But it does mean documentation. A year-to-date profit and loss showing the business is back on track, and a letter explaining what caused the dip is going to be required. Bank statements supporting the recovery story. The lender who takes the time to build that case with you is the lender who gets veterans across the finish line in this scenario. Here's the one that surprises a lot of people. Take our example, borrower. This business generated around $240,000 in revenue in 2024. But after deductions, write-offs, and business expenses, the qualifying income was $70,208 for the year. That's $5,850 a month. When that borrower went to buy a larger home, that was the number the underwriter was working with. Not $240,000, not the revenue, but $70,208. When you write off a lot of expenses on your taxes, that's great for your tax bill, but it reduces the income the VA can actually give you credit for. You can't have it both ways. Lower tax bill means lower qualifying income. I'm not telling you what to write off or not write off. That's between you and your CPA. But I am telling you that if homeownership is on the horizon, that is a conversation worth having before you file, not after you get denied. Most veterans think the biggest factor is credit score. It's not the only thing. VA underwriting also cares heavily about residual income, stable income history, payment history, compensating factors, the full financial picture. A veteran with a lower credit score but stable documented income and strong residual income may look better to an underwriter than someone with a higher score and financial chaos on paper. Some self-employment scenarios trigger a manual underwrite. A manual underwrite means a human underwriter is reviewing the full file with more detail instead of running it through an automated system. At my company, we do manual underwrites regularly. They are not a death sentence. It's not something to be scared about. They just require cleaner documentation and stronger compensating factors. But they get veterans approved in scenarios where automated systems would have kicked them out. If another lender told you no because of a manual underwrite situation, that is not necessarily the final answer. So here's a recap. Self-employed income absolutely qualifies for VA loans. The VA wants 2 years of self-employment history. Less than that requires more documentation. Income is calculated on your net taxable income after deductions, not gross revenue. Depreciation gets added back, and most other deductions do not. If income increased year over year, underwriters average those 2 years. If it decreased, expect them to use the lower year and ask more questions. Self-employed qualifying income is already a reduced number because of write-offs. A good loan officer understands that context when evaluating debt-to-income ratio and housing affordability. It is not the same as a W-2 borrower at that same number. Tax write-offs reduce your qualifying income. Know that trade-off going in, especially if you're planning to buy. Get your documentation together early and work with a loan officer who actually knows VA underwriting. If you're a veteran and you feel like somebody talked over your head, didn't really explain your VA loan benefit clearly, or made you feel like you weren't going to be able to use the benefit that you earned, then you might just need a better game plan or a second opinion. A lot of times one lender saying no does not mean the answer is permanently no. If you want help building an action plan, figuring out whether this is an overlay issue or just understanding how to better leverage your VA loan benefit, reach out to me directly. Look me up at dallasfrye.com. A link to my contact information is in the comments. And if this video helped you, subscribe to the channel, comment on videos you want to see more of, or if you have any questions, drop them in the comment section, because we put out VA loan education videos every single week designed to help veterans build wealth through real estate.